Hello everyone, and welcome to today's lecture on the types of liquidity. So in today's lecture, we're going to be covering off trendline liquidity, equal highs and lows, inducement, imbalance, as well as internal range liquidity and external range liquidity. So starting off with trendline liquidity, when we have a series of mitigations like this, so we can see here we have bearish market structure in that we're setting lower lows, lower highs, lower lows, and lower highs. When they're flat like this and we don't have any high which sort of spikes up and closes above one of the previous highs, then we're creating liquidity in this zone here, okay? And this occurs for two reasons. So as we discussed in the previous lecture, every high will have liquidity resting above it. And if it isn't taken, then we're going to just create this whole chain of liquidity. And the other thing is that each one of these highs sets a lower low. So this high here sets a lower low than this low. Then we have a lower high, another lower low, another lower high. So each one of these, in theory, is a protected high and shouldn't be broken above. Therefore, a lot of people who'd be entering sells along any of these bearish legs, they'd have their stop losses resting just above here. And breakout traders would have buy stops on the opposite side so that if price does breach above, they'd be entering along. So they're the two reasons that we're going to have liquidity resting in areas such as these. So if we had a supply zone just above and then we'd broken below, then we've set these. Essentially, we can look at this whole region as liquidity, and we will be very, very cautious when entering. We can still enter, and depending on what sort of the overall market conditions are and supply and demand and everything else, but we'd have different sort of targets as well, as we can just have this, a sort of reaction from this point before price sweeps all of this liquidity that it's created to tap into a higher supply zone. So whenever we're going to have flat highs like this below a valid POI, they're most likely going to be used as liquidity for the zone above. Let's look at a chart example. So this would have been a valid supply zone that set a lower low. See these highs here, how they're flat, and there's not much momentum in them at all, as opposed to like something like this here, which was a sharp push down, which swept liquidity below all these lows. These ones here, they're just very flat and there's no real volume entering into the market. And so on the way back up, these are all going to have stop losses above them each time someone's taken a short from here and set their stop loss above, and as well with breakout traders wanting to go long if these are broken. So price comes back, takes all that liquidity, and in this case, we actually sweep the whole POI as well, which is one of the liquidity models we're going to be discussing in the next lecture. But for now, just have a look at this as flat highs whenever we're going to have no momentum in the market. Ideally below a nice POI, then we can expect all of this price action to be swept. It also obviously works in the opposite direction. So this here would be setting liquidity above these, below these lows. So each one of these lows has set a higher high, higher low, higher high, higher low. So we have bullish market structure in this point here. But as they are flat in nature and they're not aggressive like this one here, these are also going to have trendline liquidity resting below them. And we can expect that when price comes back down, it may sweep all of this if there's a nice demand zone below before then continuing bullish. So having a look at an example here, these here, we've got some buy to sell wicks, which interacted with this supply to the left. Then price is pushed up. It set these flat lows, that in the sense that there's not much momentum in anywhere here. And then what we see is price actually coming all the way back down, sweeping the liquidity that would have been generated below all of this to then continue with bullish. So that's what trendline liquidity is going to look like. Equal highs and lows. So as we've discussed in the last lecture, we're going to have liquidity resting above and below every major high and low set in the market. So in this case, the first high here, so this one here, will have significant amount of liquidity resting above it. So as we're going bearish here, a lot of people would have stop losses above here, and a lot of other breakout traders would have their buy stops above here as well. Then what we see is price coming back to this area. And now us as supply and demand traders or SMC traders, we'd want to wait to see this being swept so that we've had enough liquidity to continue this move down. But if price actually just stops and it sets a high which is maybe 1 to 5 pips away from this, so it doesn't have to be an exact equal high, it doesn't have to be to the pip. 1 to 5 pips is fine, and then pushes down, then we expect that that was just to generate more liquidity, and that price will actually come back up and take everything that we've created here. So that's something to keep in mind as well. So when we have equal highs, it's best to wait to see them swept. Just depends on the time frame and everything else as well, but we are going to break that down when we go through the actual liquidity models and the entries module next week as well. So if we have a look here, so we've set this lower high in the market, which has gone on to set lower lows. price then comes back and stops exactly to the pip as to where the previous high was, and then we see a reaction. So what this is people would already be saying, okay, this is the point where the market's going to turn. So they would be entering sells here, and they'd have stop losses just above. And again, we'll have buy stops in the other direction as well for breakout traders. So what price does is it comes down, makes people believe that they're actually in a winning trade, only to come up, sweep all of their stop losses and the buy stops before then actually continuing into the right direction. So essentially what we're trying to do is wait for the liquidity to be taken so that we ourselves aren't liquidated. And again, it works for equal lows. So this would be the same thing. Below this low here, there's going to be a lot of liquidity. Everyone taking buys are going to have their stop losses below, and there will also be sell stops for breakout traders. If price breaks below here, let me enter a sell. And then once we retrace to this zone, price stops either at the same pip or 1 to 5 pips higher, then we can say that we've actually just set equal lows, and we can expect that price will actually sweep all of these. So this would ideally not be the best place to enter a buy. We'd wait for it to be swept, see another change in order flow bullish before then entering along. So we can see here in this example, so we've set this low. Everyone that would have buy trades throughout here, a lot of the stop losses will be resting below here. There'll be stop losses below each one of these, and this is what internal range liquidity is going to look like, as we're going to have a look later in this lecture. And then these lows here, they don't come exactly to the pip, but they're within 5 pips away of this low. So price stops here, and then here we actually have a nice bullish push up, where a lot of people would think, okay, this is the move, this is the continuation long. So when price comes back, let me enter a trade off of this demand zone, and so I can continue long. And then what happens is price actually sweeps all the liquidity resting below these lows before making its real move bullish. Again, our job is to be patient and just wait for that liquidity to be taken. Inducement. So inducement is somewhat similar to the equal lows and highs. However, it's not going to be as close as 5 pips away. And there are little different characteristics. So oftentimes price is going to create a nice POI to trade from, like this supply here, and then not retrace all the way to it. So again, what this is going to do is once price stops here, pushes down, and then we'd see a change in order flow, because this would be a change of character. Once people see this move down, they'll think that they've missed the trade. And so when price comes back here, they'll want to enter a sell at this point, because this would be the change of character level, and they'd believe that price isn't going to retrace all the way back up here. The other thing is people who take entries on the 1 minute, if this was the 15 minute, for example, if they've pushed down, come back up, and there's an entry on the 1 minute, they could already be taking shorts along this leg and along this leg as well, with stop losses resting here for price to then come back up, target all that liquidity before then creating the real move down. So this creation of liquidity is actually used to induce early sellers to actually enter the market thinking that this is where the market's going to return and continue bearish before then sweeping all their liquidity and then continuing bearish. So that's why it's called inducement. So if we have a look here, we've got this supply zone which set lower lows. Price comes back up but doesn't actually mitigate the whole POI. And as price continues bearish here, a lot of people are going to be entering sell trades throughout all of this leg here, especially on the 1 minute. And then what price does is it comes back up very aggressively to sweep all the liquidity resting here. And we actually sweep the POI as well, just by a tick or two, before then continuing bearish as we actually anticipated. So again, we're just waiting for this to occur before entering so that we don't keep entering from less than ideal zones and taking stop loss after stop loss. It obviously works in the opposite direction as well. So we'd have a demand zone here, price pushing up. We'd expect for price to retrace all the way back to this demand zone. However, it stops a bit short, continues bullish, again, inducing early buyers into the market at this point and here as well, to then come back down, sweep all their liquidity before then making the real move. So again, we're just waiting for this to be swept before actually entering ourselves. Here we can see how that actually looks in the market. So again, a very nice demand zone here, fully engulfed POI. A lot of buy trades would be taken along these legs. Price will come back down and stop early. And once we see this push, a lot of people would be entering here. And then another push, a lot of people will be entering here, thinking that we're just not going to mitigate the extreme in this point, because not all the time we don't actually have to mitigate the extreme every time. But in this case, we've built this inducement, price comes back down, taps into this liquidity pool, and then continues bullish. So again, we're just waiting for this to occur, and then ideally on the 1 minute, dropping down into this piece of price action and getting a trade here. Imbalance. Okay, so imbalance or fair value gap or inefficiency, if you've done other sort of courses, a lot of people carry on about this a lot. I think it gets a little bit more attention than it really requires. It's essentially just created whenever we have an influx of one type of order, buy or sell, which significantly outweighs the number of orders in the opposite direction. So for example, where we'd have a large amount of sell orders being initiated, with not a lot of buy orders at checkpoints along the way to cause any form of interruption to the seller's momentum. So what I mean by that is this here would be a supply zone that set a lower low. If there was nothing to the left as a catalyst for a pullback or a demand zone where there'd be buy orders, we'd have imbalance because a lot of sell orders would be initiated and there's no buy orders in the opposite direction to actually cause any sort of momentum, to pause any of its momentum. So whenever we have imbalance in the market, it results in a lack of structure because essentially we usually have just one or two very sharp, big candles, engulfing candles, and they don't actually give us any structure to trade off of. And as we know, most liquidity rests at or above or below structural highs and lows. So if throughout this imbalance there is no structural high or low, because there won't be when we have imbalance, then we have no liquidity in this leg to be targeting. Therefore, we should actually look to target the liquidity above the actual supply zone or below the demand zone. And we'll have a look at that here. So what we can see here is we've got a supply zone. This is what imbalance looks like when we have one very big candle as such. I usually use this box here just to identify that there's no liquidity in the leg. So if there's no liquidity to be targeting here, then the next point of liquidity is going to be this high itself. So what happens is price comes, interacts with this. A lot of people would be entering sell trades here, but as we didn't have enough liquidity to continue the bearish move, we needed one more spike up to sweep the liquidity above the supply zone before then continuing bearish. Going to sound like a broken record, but all we need to do is wait for the liquidity to be taken before entering. And obviously it works in the opposite direction as well. So here we'd have a demand zone, a very big influx of buy orders and not many sell orders on the way to cause any sort of interruptions. So when price comes back down, there's no structure here, so there's not a lot of liquidity to take. Therefore, we need to take the liquidity below the low. If we have a look at this here, we've had interaction with this supply zone, created this demand zone. A lot of bullish orders were entered here, resulting in imbalance. Because we have imbalance here, there's not much structure in this leg at all. Then when price comes back down, it actually needs to sweep the liquidity below this low to then have enough fuel to continue its bullish move. So lastly, we're going to look at internal range liquidity and external range liquidity. So when we refer to internal range and external range liquidity in this course, we're going to be referring to the range as our daily or 4-hour or our 15-minute range. So from the high to the low. So from the 4-hour low to the 4-hour high, that's our 4-hour range. So beneath each low and above each high within the range, we're going to have internal range liquidity. We're going to have internal range liquidity here. We're going to have internal range liquidity here at this high, at this low, at this high, at this low, at this high, and this low, and so on and so forth. So the liquidity generated here is what allows us to push up and create a new higher high. And then the liquidity resting below here is what we're going to sweep to give us this pullback before we continue bearish. When we continue bearish and we set a new lower low, we're going to have internal range liquidity above the previous high as well, which is going to be used later when price does retrace to sweep the liquidity above these highs as well. If we do actually sweep the entirety of the range, so if this here is our 4-hour low and we actually sweep below, that's when we say we've swept the external range liquidity, and we can expect the actual pullback after sweeping the external range liquidity to be a lot more significant than when we sweep internal range liquidity. So internal range liquidity is ideally going to be under catalysts for pullbacks, which is going to actually allow us to have a little pullback in the opposite direction, but there's not going to be a huge amount of liquidity resting under here, depending on, of course, the structure and everything else at the time. But ideally, and most of the time, there's not going to be sufficient liquidity resting under here to cause a real big move in the market. It's just going to give us some sort of a pullback to continue taking shorts until we retrace into into discount. And then if order flow was to turn bullish at this point, we can then be taking continuation longs. This is not so much about entries. Just know that in terms of internal range liquidity, it's going to be below every low within the range and above every high within the range. And then external range liquidity is going to actually rest below the 4-hour low or the 15-minute low or the daily low, and above the 4-hour or daily high. So let's have a look at this chart. Okay, so what we can see here is we've got our 4 hour low and we've got our 4 hour high. So all of this here is our 4 hour range. So here there would have been liquidity from the previous range. Price has pushed up and swept that liquidity, which gave us this pullback. I've actually gone a little bit too far. Even this little stop here. So when we start at the bottom, we push up, we create this low. We're going to have internal range liquidity resting below here, as when people are taking buy orders along this leg, they're going to have their stop losses resting just below here. Then we push up, we sweep the liquidity above this previous high that we were just talking about, and then we push down. We can see with these two inside bars as well, we've created liquidity, we've swept it with this candle here, and this is what I use to actually represent a sweep. So you can use the same if you like, or you can just write sweep or liquidity or whatever you'd like to do on your charts. And then we push up, we push down, and then once we actually, so at this point, we've got internal range liquidity here. Why do we have internal range liquidity here? As we've set a lower low, so anyone taking sells along the way here will have stop losses here, and anyone looking to take a buy stop as a breakout trader will have buy stops here. So price knows that there's going to be liquidity here. It's going to push up, take all that liquidity, and push lower. Once we've pushed lower throughout this leg on the 15-minute, there's going to be bearish structure, and then therefore there's going to be internal range liquidity above this high, as everyone taking shorts throughout this leg is going to have their stop loss here. What we see is we had internal range liquidity here as well. When price set a higher high, a lot of people would have thought that this was a protected low, so they would have set their stop losses below here. Price sweeps all of those stop losses and then continues bullish. We see here price pushing up, would have interacted with these buy to sell wicks here, pushes back down to sweep the liquidity below this low. Therefore, this low should now sort of be protected once we've set another higher high. But we'll see when we come back to this region over here that it's actually going to become swept as well. And then as we push up here, we can see these here. This would be trendline liquidity, where we see flat highs like such, where we haven't actually had a significant push that would have swept liquidity like this one here. So when we have these, we know that we're actually just generating liquidity below. And what do we see here? Price pushing down, sweeping all of that liquidity, pushing up, and then sweeping liquidity above this supply zone as well to continue lower, setting this low at this demand zone, giving us a slight pullback, but then again, sweeping the liquidity created in people's stop losses here before continuing bullish. So we can see this occurs everywhere throughout the market. We have more trendline liquidity being generated here. We have internal range liquidity here once we have this lower low, so people would be moving their stop losses above this, above this high, yep. And then we've had more internal range liquidity generated here once we had another lower low. And then we've pushed up, created a new supply zone, which set another lower low, more internal range liquidity here, which will be swept on the way back up. And then below this actual 4 hour low is where we're going to have the external range liquidity. And as we can see here, once we've actually swept that external range liquidity, we had a very sharp, aggressive pullback. And that's what's going to happen, the difference between sweeping external range liquidity as opposed to just sweeping internal range liquidity. So hopefully this video has made sense to everyone. I do recommend that you go back and watch it a few times. And if you do have any questions, please DM me on Discord. But we do have 2 more videos left in this module.